Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. European futures follow the worldwide equity rally after President Trump's partial tariff pause turbocharges markets. But US futures point lower. No relief for China as the US president hikes tariffs to 125%, but says he can't imagine raising them again. Plus, Volkswagen cites the tariff threat as partly to blame for its 40% profit drop, while Air France cuts some transatlantic fares as corporates begin to count the cost of the trade war.
A quick check on these markets. Anna, you mentioned there the rebound. Just how big this rebound is pretty important. Higher by almost 8% on Euro Stoxx 50 futures, but a real divergence from what you're seeing in the United States, where futures are down about 0.3%. The catch-up trade in Europe very much afloat. But let's talk about this bond put here. We're looking at a 10-year at 4.29, a 65 basis point move in the course of 4 sessions. Of course, that weighing on the dollar here as you start to see that retreat, but not against the Chinese yuan. That's the currency exception we're going to keep our eye on. The countdown to the opening trade starts right now.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. A lot of winning out there, and we're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Our country's stronger than it's ever been, and somebody had to do that with, we had to take the medicine.
Trump blinks, takes a victory lap, but appears to have met his match when it comes to the bond market. Cree, that was an amazing day. It came mid-session, which is amazing. Trump appeared to front-run it with a comment on it's time to buy. The market certainly got the message after we saw the tariff pause. But where do we go from here? I
mean, the volatility is incredible. We almost hit, we were very close to 5% in the course of 4 sessions, a 65 basis point move. I'm curious if he's responding to the level that we're at. I'm curious if he's responding to the volatility that we're at, or perhaps the warnings within his own cabinet.
Yeah, was it the number that did it? Was it a particular yield, or was it specific language from somebody he trusts who got in his ear and said, we have a great story on the Bloomberg terminal to taking us inside that sort of turnaround. But there are various contenders for that position, I suppose. What stood out to me is, yes, we rallied a lot yesterday in risk assets. Of course we did, on the back of what we heard here. But the S&P had its, as Tom was telling us, the best day since the great financial crisis. But we haven't even erased all of the losses of April. So just to put it in context, you know, we haven't even gone, and what is it, the 10th of April? So we haven't unwound 10 days of losses in one day. That's how much we fell into this.
So where do we go? What is happening here? And to your point, where do we go? Do we return back to where we were before? Trump talks about this coming from the heart. It's not coming from his head, it's coming from his heart.
Yeah.
Do US assets therefore demand some kind of a discount, Trump discount, as a result of this? We can't go back to where we were before because the volatility is now in the market. It's already in play. So what kind of a discount do you now apply? On what? How do you calculate that?
How do you calculate the market moves? But then there's some places where you didn't actually see that much of a change. For example, in Fed pricing, that hasn't changed much at all. You are still seeing the cuts kind of put further back. Recession odds have flip-flopped based on these announcements. We saw that even within 60 minutes of Goldman Sachs putting out a talk of, I think, 79% recession odds, only to kind of flip it minutes after Donald Trump had announced down to 45%. I want to bring up the one other piece I thought was really interesting, because the conversation on this show yesterday was, do people even want to touch the bond market? Do they even want to be touching any of these American assets, given that we've seen so much of the momentum and the safety associated with it kind of in question? Take a look at the 10-year auction yesterday that happened before all of these announcements.
Yeah.
Record indirect takedown.
Yes. So, yeah, try to draw any conclusions as to international appetite to own bonds and all of the other dynamics we've been talking about in the programme this week.
Honestly, I don't know how you look at this market and make rational decisions. How do you look at this market and go, I can invest in that? Can you make investments at this point, given the whippy nature of what is happening here? The bond market's all over the place. Yeah, people are buying the 10-year. They're going to buy the 30-year today. What happens next? We're 90 days away from another set of tariffs. What kind of volatility are you going to see between now and then? Who is Donald Trump listening to? What comes next? He said he's not going to raise tariffs on China. but he's raised them to such a level that actually you're pushing on a piece of string at this point. I don't know how you make concrete decisions, and I think that's the problem when we come to the earnings season that's about to arrive.
Yeah, that's going to be really problematic. We'll get into the earnings, the corporate stories in just a moment. But to add some important context to your earlier question about whether we go back to where we came from, I think the verdict I've got from reading lots of notes this morning seems to be no, we can't. We've learned too much over the last 10 days to go back to where we were. And I think that's nicely illustrated. Not only have we learned too much, but we've actually still got a lot of tariffs in place. And that's nicely illustrated by the chart that our colleague Dan put together, which shows that we've gone from an average US tariff of 27%, that was yesterday morning, that's what we were talking about, to an average US tariff now of 24%. So if you look at the historical context on what's happened here with tariffs, that first blue bar is the jump up on the intended plan from the Trump administration. The rollback looks like that, the move down into the second bar. So it's really not that much of a pullback. We still have tariffs on China, obviously, Mexico, Canada, 10% all round, steel, aluminium, autos, and that adds up to a huge amount of tariffs in the global system.
It does. And therefore, we don't know what the effect is going to be. What is earnings season going to tell us? Where do we go from here in terms of the US economy? Can I really take the recession call off at this point? Do I know what the Fed is going to do? The Fed is basically signaling, we got a lot of this yesterday, that it's still worried about the inflationary narrative. That is still the major concern that it is dealing with right now. We've oscillated over the last few days from 5 cuts this year to 3 cuts, which is kind of where we are now. That's a huge swing.
It is, but all the time, people telling us the Fed isn't the one that can save the day, at least not in the short term.
Yeah,
and
the Trump put is what we got yesterday. Yeah. Trump is clearly watching what is happening. He appears to be watching what is happening with the stock market, the bond market, less to do with the stock market. So is the stock market at risk as a result of that? I don't know in terms of how the bond market therefore reacts and where we go next.
Yeah.
What does the economic data tell us next? Do we start to see a pullback? Are we back to where we were before?
Well, just the fact that we're going back down to 10%, which feels like a relief in theory relative to the news flow, it is still significantly higher than what we had before, which is 2.5% out of the United States as the kind of tariff rate. So go from 2.5% to 10% is where it comes
10 from. To 24.
Yeah, absolutely.
Yeah, you include all the other tariffs, but your point about 10 is obviously right for those countries that had expected a higher tariff now come down to 10. Should we go on to the corporate agenda? Because I think this is really interesting. It gives us clues, actually, to what you were asking about how corporates are going to handle this. Because if VW is anything to go by, they won't know how to adjust their costs.
So Anna sent a quote out from a story first thing this morning, which really, I think it tickled you and it definitely tickled me. This is the line from Volkswagen. This is this story on Volkswagen this morning. The carmaker said in Wednesday's statement that it couldn't yet determine the extent of the effects that tariffs will have on its sales, profits and cash flow. Excluding those impacts, the company confirmed its full-year guidance.
There we are. Is that going to be the story of Q1? Is that the earnings playbook? Is that the guidance playbook that we're going to get from European corporates?
Well, I think global corporates, Walmart widened its operating expectations. Like, it kept broadly guidance unchanged yesterday. Delta, Ed Bastian basically kind of said, I don't know what's going to happen next. This is the problem. This is the uncertainty that is being created right now. This oscillation that we're getting from Trump's heart is creating such volatility that you do wonder what corporates can do at this point in terms of making investment decisions, let alone what individuals can do, what fund managers can do in terms of the investment decisions that they're going to make.
Well, over the weekend, Stephen Moran made the point that eventually companies have to decide. They have to make a decision. And I think the reaction function is panic. So you mentioned Walmart there. Walmart, there was a story on the terminal this morning that they're asking their Chinese manufacturers not to put price stickers so that they can have that volatility. And that's a really big deal because their motto is everyday low prices. That Walmart has struggled to pass on consumer costs to their fairly low-income kind of demographic. So that's one concern. Amazon pausing shipments that are mid-route in the middle of the ocean, saying, hold on a second, we need to reroute this.
Yeah, scooters, air conditioners, all kinds of other products that Amazon had previously said it wanted to buy from Chinese vendors, an array of Chinese vendors, apparently, and pausing those. So, yeah, this is...
what China does next is also going to be really important in this. Devaluation of the currency, to what extent is that now on the table? If that gathers pace, how does Trump react to that?
And China has another meeting coming up today.
Precisely.
Another meeting of leaders. We were saying that yesterday, and then a lot of things happened. So we'll see what happens this time around.
But are we 125%? Basically, you're at the point now, you've probably already passed the point where Chinese exports don't work into the United States. His point about, I'm not going to raise them further from here. Well, you've raised them to the point where If you raise them any further, it's going to have zero effect because the tariffs are already so high that the effect is fairly dramatic. So we're already we've reached the ceiling, apparently, or it would appear in terms of what tariffs look like. Let's tell you what's coming up on the show. Lofty Karui, Goldman Sachs Chief Credit Strategist, is going to be joining us. That's a conversation you want to listen to. John Bilton, JP Morgan Asset Management, Multi-Asset Strategy Head, joining us a little bit later on. Marina Zavalok, Morgan Stanley's Chief European Equity Strategist, is going to be joining us as well, as is Silvia Vivano, UniCredit's Equity Capital Markets Head. I should probably read those more slowly. But it's an exciting morning. There's a lot going on.
There's a lot going on, and a little bit of silence beginning as well. The ECB quiet period does kick off today, which is interesting, given that we may actually hear a little bit more from the Fed later on today as well. Michelle Bowman, the hawk, and I believe now he is taking on a different role within the administration as well. The vice chair for supervision also will be speaking. We also have plenty of other data as well, including U.S. CPI. We didn't even mention that we are getting inflation data. Does it even matter if we're going into more forward-looking of a conversation, and jobless claims as well? Plus Austin Goolsbee, who has historically been far more dovish, also hitting the wire.
I wonder if it's a relief if you're a central banker and you go into a quiet period. At this point, I imagine it could be, couldn't it?
Goolsbee's been speaking a lot this week, so yeah. He's probably quite relieved.
He's had a lot to say.
What else do you need to know this morning? There are a few other stories. US steel shares tumbling as much as 16% in post-market trading after President Donald Trump says he does not want to see the steelmaker owned by a Japanese company. Speaking from the Oval Office, Trump pointed to the producer's rising orders as evidence that it doesn't need any investment right now. Investors piled into US steel shares in recent days on hopes that Trump would reverse the decision to block Nippon Steel's takeover bid. Airbus delivered 136 planes in the first quarter, just edging out rival Boeing. The European plane maker says it stepped up handovers in March, getting 71 jets out, up from 63 in the same period last year. That is actually a shot of Airbus's delivery centre in Toulouse, so that's appropriate. Boeing reported 130 deliveries in the first quarter on Tuesday, its best performance in over a year. And US Chief Justice John Roberts has agreed that President Trump can temporarily oust top officials at 2 independent agencies. This while the Supreme Court decides how to handle a new showdown over presidential power. The legal wrangling could ultimately affect whether Trump has the power to fire Fed Chair Jerome Powell.
Yeah, and that's why we watched that story, because of the link it could have to the Fed. Coming up on this programme, European futures point to a mega rally. You won't want to miss the start of equity trading this morning, Thursday, the 10th of April. Futures are pointing considerably higher. Euro Stoxx 50 futures up by more than 7%. Plus, VW is just one of the big companies counting the cost of the tariffs, and that's even before they'd have been applied. We'll dig into the corporate story as well for you. Up next, we'll head to Brussels, where Oliver Crook will be joined by the EU Commissioner for Technological Sovereignty, Security and Democracy. We're thinking tech regulation here. If you have any questions of your own for our guest, please get involved. IB plus BBTV Go. This is Bloomberg.
Good morning. 30 minutes to the equity market open. Sorry, 43 minutes to the equity market open. I'm getting ahead of myself, probably because we're all excited to see what is about to happen. I think you can probably take it to the bank. The European equities will be opening higher this morning. How does the EU manage what is happening in terms of its transatlantic relationship? What is happening in the tech space? What happens in services? The EU has approved tariffs to hit around 21 billion euros of US goods in retaliation for Trump's metals levies. Let's talk about what happens next. Let's go to Brussels, where we find Ollie Crook. Ollie, what does the tariff pause now mean in terms of Europe's strategy?
Absolutely. I mean, it fundamentally changes Europe's strategy, right? Initially, those 20% tariffs meant that next week, basically, the Europeans need to come up with a full architecture of how to retaliate to those U.S. measures, not just necessarily tariff measures, maybe looking at something in the tech space. And again, it's also a sort of fundamental question from the Trump administration, because the Trump administration is not just citing trade barriers and tariffs. They're talking about non-trade barriers, monetary barriers, so-called. They refer to basically VAT. They refer to regulations on food safety. They also refer to regulations regulation on their tech companies, which is very relevant to our next guest, who is Henna Virkkunen, who is the Executive Vice President for the digital space here in Europe. Thank you so much for joining us this morning. You've also announced your action plan for AI as well yesterday. I'd like to start, however, if we can, in the United States, just on your reaction to what we've seen from the Trump administration over the last week and where we are today.
Of course, we are welcoming now that we are going to continue the negotiations, because it has been all the time the message from the European Union side that we want to negotiate, and we don't want to have tariffs, and we don't want to have trade war, because we don't see that anyone is benefiting from that. And of course, it's very important for businesses and industries to have legal certainty and also stability.
And one of the other sort of issues, I think, that we can say that there's still basically a trade war in place. We're still dealing with 10% tariffs from the United States. We're still talking about potentially not the end of hearing from what the United States would want. There were discussions about how Europe could retaliate on the tech sector, which is one of the places where really Europe has the most leverage on the United States. Have you been parts of this conversation? Have you been at least investigating what tools you have available to potentially retaliate against the United States?
Our main message is all the time that we don't want to have tariffs, and we don't want to have trade war. So we want to negotiate, and we want to have good relation with the USA and also with the companies. European Union has been always very open for tech, for USA and tech, and we would like to continue, of course, that.
But the United States has been regarding potentially tech regulation as a non-tariff barrier. Do you anticipate that that is going to be a conversation that you're going to have, and that might be a bit of conflict with the United States?
This is a very separate thing from trade, because, of course, when it comes to European digital rules, these are same rules for everybody. So these are not like trade rules. So when we speak about Digital Service Act, Digital Markets Act, or AI Act, we know that we have same rules for all the companies who are operating in the European Union. So for the European companies and also for Chinese or USA companies. So it's very fair for everybody, and these are not creating trade barriers.
And the Digital Services Act, we've been expecting some decisions specifically on Meta and on X. Is there a delay to that due to the pressure being put by the Trump administration? When can we expect progress on those?
We have several investigations going on under Digital Service Act, 10 different investigations, and of course we are enforcing the rules, respecting also the due process. So always when we are doing investigation from the Commission side, of course, the main purpose is also that we want that the online platforms, that they are complying with our rules. And often this is the case during the investigations, that they are also changing their behavior. And that is, of course, what we want, that they are respecting our rules.
And so, for example, with X, which is, I think, the most advanced investigation that you have, what would you like, what is the end game? What would you like X to look like? How would you think is an appropriate way for it to sort of shift?
What we are saying in our rules, it's very much that online platforms, they have to have the processes in place, that how they are assessing and mitigating the systematic risks they are posing for civic discourse, for electoral processes, for people's well-being, and also that they are transparent with their actions, that the users know, for example, why certain content is shown for them, and the users has to have also choices how to change also the recommender system.
And I'd like to also get an idea of your sort of channel of communication to these companies. Have you spoken, for example, to Elon Musk? Have you spoken to Mark Zuckerberg? Who have you spoken to of the tech CEOs, and what are those conversations like?
Normally, it's, of course, our Commission's technical team who is working with those platforms' technical teams, with their lawyers, and that is all the time the dialogue we have going on. So when we are enforcing the rules, it's not only the investigation. So we have all the time several parts. So we have all the time dialogue with online platforms, especially, of course, it's done by our services. And then also we have different code of conducts. We are preparing different guidelines. Online platforms, they are also carrying their own independent audits. So there's several parts all the time how we are implementing and enforcing the rules.
Mm-hmm. And then are you planning a trip to the United States? Could you see yourself going to D.C. and Silicon Valley and having meetings with some of these people, and when could we expect that to happen?
I would love to, of course, visit in USA as soon as possible. So we are looking, of course, the calendars. I have to say that it has been also quite busy from the Commission side, this start with all the security environment where we are now. But, of course, I would love to travel to USA in the coming weeks.
And another sort of issue that was put really into focus during the Munich Security Conference, we had J.D. Vance here, who's being very critical of sort of European free speech. Do you think that Europe and the United States have the same concept, and this administration have the same concept of what free speech is?
There might be, I think, some differences, but I think it's important all the time to underline that freedom of speech is something that is very fundamental right, also in the European Union. But of course, we see also that there's also other important fundamental rights. So in the name of freedom of speech, you can't do whatever. So there is also limits. But when it comes, for example, to our Digital Service Act, it's clearly said that illegal hate speech, for example, it has to be taken down. So illegal content. But we are very much respecting, of course, the freedom of speech.
And then that's sort of dealing with the today. Looking into the future, AI is obviously going to be one of the crucial issues for Europe in order to stay sort of relevant economically in the world. You've put out your AI Continent Action Plan. What is within that plan? And are you going to have to make some differences, some changes to the European AI Act in order to sort of streamline it, make it simpler, to really attract that kind of ecosystem here in Europe?
That's what we have said, that we are very committed to simplify the processes and make Europe easier for the businesses. We want to encourage innovations and investments, and that's why we are currently going through all our digital rules, and we are looking how we can cut the administrative burden and bureaucracy, how we can simplify the processes. But especially when it comes to AI, we are now investing heavily to our computing capacity in the European Union, because we have a very strong research community in the European Union. We have more researchers on AI than any other country or continent in the world. And also we have thousands of startups who are working on AI, but they are lacking access to computing capacity, and that's why we are investing to infrastructure.
And so concretely, what kind of measures are we talking about? How much of this could be rolled up? Could you say something like 25%, 30%, 50% of regulatory burdens we pull back? What kind of scope are we talking about?
That's what we have said from the Commission side, that from SMEs we want to cut 35% of the costs what they are made because of bureaucracy, and 25% from all the industries. But this is on all the regulations, not only on digital rules, but we are also looking at the digital rules here.
Elhena Virkkunen, thank you so much for your time today. That's the Executive Vice President here in the European Union for all matters of the sort of digital world, which increasingly gets mixed up with trade, gets mixed up with regulation. And so those are the views there from Brussels as they try to put out their AI plan to compete on the global stage.
Bloomberg's Oliver Crook walking us through what that potential retaliation on the digital front and the services front may actually look like. We thank you so much. Let's bring it right back to the markets here, because tariffs, as Ollie mentioned, are still top of mind for traders, despite news that Donald Trump paused most of them for 90 days. Let's bring in Bloomberg's Valerie Teitel to walk us through the latest market moves. Val.
Critty, what an insane day for the markets. We woke up thinking that the Treasury market was going to completely implode, and we went to bed with one of the biggest modern rallies for the S&P 500 in modern history, clocking the fourth best swing from low to high for the index, 10.8% swing. It clocks just behind the best 2 days of the global financial crisis and the day after Black Monday. And boy, there were massive volumes behind this. Flip the board and take a look at the U.S. total volumes for U.S. exchanges. Clocked another record on this move yesterday, and this euphoria also hit the bond market. Those two-year yields at some point, Critty, yesterday's session were 30 basis points higher as we unwound some rate cut expectations for the Fed. 2-year yields crossing 4% as well. The euphoria also took place in the corporate bond market. IG spreads in the U.S. saw their biggest move tighter in 5 years after this announcement, as we've seen most of the widening of credit spreads in the last few days retrace.
Valerie, thank you very much. Valerie Teitel with just some of the moves and counter moves that we've seen over recent days. So we are expecting a really big swing at the start of trade. Then we're expecting European equity markets to bounce considerably. Futures up 7% last time we checked. Is worth pointing out, though, that US futures are down. And, you know, we don't know much about where we go from here in terms of stocks and risk appetite.
They're off their lows, so that's significant as well. So they've been down more than they are now. The S&P's only down by 0.4%. Equity markets are interesting. I think the bond market move is interesting as well. Much smaller, much smaller than what we saw in terms of the equity market swing.
Yeah, and some of the yields in Asia are actually going higher at the short end right now, as if their exposure to China obviously still considerable. And there's
that's logical. Maybe the Fed cuts less. Maybe that's logic. There's some logic to that as well.
Coming up on the programme, we'll talk about credit markets. How are they responding to all the news flow? That's next. This is Bloomberg. Welcome back. 30 minutes until the start of cash equity trading here in Europe. Let's have a look at that futures picture then. We are expecting to catch up with this global bounce in risk sentiment as a result of President Trump dialing back most of the tariffs for now pausing most of the higher tariffs for now, but still we have plenty of tariffs in place, and actually net we haven't reduced the tariff burden into the United States by all that much. But still, it was enough to signal something a little bit different for markets, and so risk appetite surged in the US, in Asia, and it will into Europe as well. Let's have a look, though, quickly at the bond markets, because things look interesting there. I'm seeing yields. I mean, Germany was a bit different yesterday, but European yields are not signalling, they haven't dropped back significantly this morning.
They haven't dropped back significantly. That feels a little bit more in line with perhaps what we're seeing in the U.S. session, at least overnight, the 10-year at 429 there. I wonder if this 10 basis point move, though, Guy, is in the German, has a little bit more to do with Friedrich Merz being a little bit closer to forming his government and starting that policy making.
It's been interesting that we've kind of sidelined that. That would have been a major story for us, and that hasn't come through. But we do now have at least some stability maybe at the core of Europe, which is significant, which is probably relevant. But it's the spread between Germany and Italy I've been watching over the last couple of days, which has widened out again. And I wonder kind of in the period we're in right now, how choppy that is going to be. Will the ECB talk about that? I suspect desperately it doesn't want to, but I wonder whether that question will once again be raised in the press conference. Let's talk about credit as well, and talk about what's been going on there. We've been watching that very, very carefully over the last few days. The question of whether widening spreads induced by tariff fallout, a canary in the coal mine, maybe something more sinister. Let's take a listen to what our guests have been saying on that matter.
The hubris that's been in corporate bond markets for the last 2 to 3 years is finally cracking a little bit.
It's going to come from private credit markets, levered loans, then high-yield spreads, and then it's going to sort of broaden out to the overall market if things are going to get bad.
You're going to get idiosyncratic stress. But a systemic problem for corporates, I think we have the tools to prevent that.
We don't seem to be in a systemic crisis from a market's perspective.
When high-yield spreads stabilise is when U.S. equity valuations stabilise. When equity valuations stabilise is when the market stabilises.
Opening trade guest speaking prior to Trump's tariff reversal in the hour since credit has joined the relief rally, of course, with measures of fear in the corporate bond market declining the most since 2020. Lufti Karui, Chief Credit Strategist at Goldman Sachs, joining us around the table to add his voice into the conversation. You're the first credit person I've spoken to after we've seen the reversal. Where are we now?
Thanks for having me.
Nice to see you.
Look, I think, the positive aspect of all of this is that things have not reached a point of no return. The market is still responding to headlines, but the challenges are still here, in my opinion. Look, you have a 90-day pause. Between now and then, you need to assess the durability of the ongoing recovery again. You said very nicely, the burden on tariffs is still there. It's not away. And so when you think about the mix of growth and inflation, you still have inflation going up, growth going down, and a big question mark around sort of monetary policy for the next 3 months. And so I don't think you fully reverse actually the widening that we've seen.
Has credit priced that environment?
No. I think credit had been stuck in a very, very tight range for, a year and a half. We're now close to levels that are sort of in line with historical averages, maybe a little tighter than that, but we're not pricing in a recession at all.
You're not pricing it. Well, did the credit markets ever get to pricing in a recession then, or did we escape that?
Great question. There is a belief among many market participants that somehow credit has this predictive power a little bit, that it gets you there, it gives you the answer like a month or two before. That is just not true, actually. So to your point, credit tends to be coincident. When growth troughs, that's the peak in spreads.
OK, so we don't look to it. So it's not necessarily going to give us that canary signal?
It is a view that is informed, I think, by the experience of the global financial crisis. But that was a credit crisis. Yes. Not all crises are credit crises.
Yeah, this is important. So I asked earlier this week, the Bank of America guest we had in that clip, asked, are we in a credit crunch? He said no. And he said that we have the tools to manage all of this on a systemic level, even if individual companies might get into trouble. I suppose that will still apply, even if things move a little slower from here.
Yeah. Totally. I mean, look, as violent as the price action has been, I do take comfort from the fact that the microstructure of the market, or the plumbing of the market, has actually held up very well. I know there's been a lot of concern in the Treasury market, some noise in the equity market, but actually in credit, when I kind of put the move relative to COVID, it's been very orderly in my view. We haven't seen any companies calling their banks and drawing down on revolvers. So it never felt to me that this was remotely close to what we experienced during the COVID shock.
Is that the tell for you? Is that the early signs of stress, a company calling in for that revolver?
Yeah, I mean, you have to watch primary, market activity. And if, you have no deals for like a week or two, that becomes problematic. But we haven't had that.
We have had a couple of days, maybe not 2 weeks, but we have had certainly a stretch of time where both in the public and in the private markets, deals aren't coming to fruition because of the volatility. We're not expecting an end to that volatility anytime soon.
Yes, but I don't think that was indicative of a lack of demand. When you have intraday volatility of these levels, obviously it challenges execution and syndication, et cetera. But I don't think that was indicative of lack of demand like we had in 2020.
So primary markets, they open again?
Totally, 100%, yeah.
And in terms of the pricing that is now going to be applied, though, has something changed? Will pricing be different? Is there a discount that I now need to apply effectively to what is going on just because of the volatility that we are seeing? How do buyers respond?
I think so, yeah. I mean, look, we think that the odds of a recession are somewhere around 45%, and so you have to factor that in. I don't think it's pretty much. Like, I don't think it's reasonable to expect spreads to fully retrace, the widening that we've seen. I also think that the trade-off between growth and inflation is totally different today. I mean, this is still a 15-point increase in the effective, tariff rate. So it is an inflationary shock, coupled with lower growth, and the market will have to navigate through that. So I think we're not completely out of the woods.
What about, are there specific sectors you worry about? Because with these big tariffs on China still, huge tariffs on China and counter tariffs, and then modest tariffs, or, still elevated versus history tariffs against the rest of the world. I mean, logistics companies spring to mind. Are there specific sectors that you're going to be watching for real pain enough to trigger negative balance sheet events?
Yeah. I mean, look, I think thematically, there's two things that have been very clear in my view. One, the outperformance of cyclicals versus defensives. Again, you priced in the risk of a significant growth slowdown. That's been true in the equity market, true in the high-yield market. The second theme is the relative outperformance of domestically exposed companies and sectors relative to those that are internationally exposed. Same thing. If your supply chain is sort of fragmented globally, you've come under more pressure today. I actually think the big opportunity set from an alpha generating standpoint is going to be at the single name level. I mean, we have a set of policies that are effectively picking winners and losers within sectors. I mean, autos is a great example. Not all auto companies are sort of set up the same way. And so I do expect dispersion to pick up quite dramatically. And I do expect investors to be rewarded for credit work.
What about that regional divergence? We had, as Anna was mentioning, the guest from Bank of America earlier on this week who was talking about this kind of rise that he's expecting in reverse Yankee issuance. Are you expecting a similar trend that foreign buyers are coming to Europe?
Yeah, I mean, that's sort of pretty much a yield differential story for sure. I do expect that, too. I will tell you that question comes up all the time in client conversation. How do we think about the relative performance of Europe versus the U.S.? A lot of folks have in mind the playbook of 2018. If you remember, the tariffs that were implemented in 2018 actually weighed a lot more on Europe relative to the U.S. I'm not sure you'll see the same trend happening this time around. In fact, we're more positive on the European market relative to the dollar market. This is a relative statement again. I think they both sort of follow each other with a pretty high correlation. But I think the epicenter of the shock today is the U.S., not Europe.
What is private credit doing right now? If the cost of credit goes up in the public markets, does private credit have the capacity to step in and take some of that on?
I think so, yeah. I mean, look, that was also the playbook we had in 22-23 when the broadly syndicated loan market was sort of quasi-shut down. We've seen private credit managers kind of step in and fill that gap in terms of financing. Private credit is private, and so by design, it takes a little bit of lag to sort of process all the noise that you've seen on the public side. The other question is, what if we have a recession? Actually, in my mind, you're going to test that asset class in a way that you probably didn't during the COVID shock. Keep in mind, COVID was short-lived, and it was followed by a spectacular policy response. So I don't think that's sort of the right playbook, but you'll test it at some point.
All right, Lutfi Karui, Chief Credit Strategist, I'm going to say that right, over at Goldman Sachs, joining us around the table. He's not seeing signs of stress just yet in the credit market. We are seeing signs of stress in some of the corporates. Coming up, we're going to dive into one of them. Volkswagen's operating profit falling almost 40% in the first quarter, all, of course, before Donald Trump's tariffs went into effect. We're going to dive into the performance. It is one of our stocks to watch in today's session. Stick with us. This is Bloomberg.
Welcome back. We still have 17 minutes until the start of equity trading. It's going to be a fast-paced session, perhaps. It's certainly going to be our expectation that we see some big gains at the start of trading. Euro Stoxx 50 futures up by just shy of 8%. Let's bring in Claudia Panseri, Chief Investment Officer for France at UBS Wealth Management. Claudia, very nice to have you with us. We'll dive into some of the French themes in a moment, but I just wanted to ask you about your reaction to the 90-day pause on the tougher tariffs. We still have historically a high tariff level being applied by the United States versus their history. But what kind of relief do you take from this turnaround from President Trump?
Good morning. Thank you for having me. We were expecting a turnaround, but to be honest, not with a week after the announcement. So I think everyone has been surprised on the upside. I have to admit that there is a change, there is a pause. But the underlying situation is very critical. I mean, the level of tariffs remain very high. The main partner, I'm thinking about China, have a level of tariff which never been seen before. And I think the uncertainty will put growth in U.S. and outside U.S. in a slowdown pattern. So the market is trying to reprice the risk today. But what I see quite interesting is that the dollar is not reappreciating so much. So it's also meaning that people are still looking and trying to understand what's going on.
Yes, the dollar is on the back foot this morning. We're also seeing selling of the short end of various bond market curves. And I wonder what that means to you here in Europe, Claudia. So I'm looking at yields on the 2-year in France up by 15 this morning, the 3-year up by 13. What does that tell us, given bond markets have been the epicenter of such stress over the last 24 hours?
Yeah, I think there are a few things. One, the interest rate cut from the ECB and the Fed was adjusting on the downside, so people were expecting more repricing. We have seen 5 rate cuts price in U.S. just after the 2nd of April. That was the case also for the ECB, with more cutting going down to 1.5. So after yesterday's announcement, I think people are repricing again central bank monetary policy. We also had an announcement yesterday about a coalition agreement between the CDU, SPD in Germany, which may put some pressure as well on the long part of the yield curve. So there are a few factors. The interesting part, and I'm wondering this morning the reason why we had such a decision yesterday about the pause, was the big jump in the 10-year in U.S. Was it due to liquidity issue? Was it due to about stress, about inflation? That remain still a case to be studied for me. But the bond market is not reacting, and it was as it's supposed to react when you have a slowdown in the economy. We still expect interest rates to come down anyway. Rate cuts coming from the ECB next week, rate cuts coming in June and September, and probably in after from U.S. So we should have some adjustment on the downside on the yield.
Claudia, it's Creedy in London. You've mentioned kind of this lack of reaction in the dollar, as well as some of the news flow coming out of Germany as well. I'm curious what the safer asset is in this environment, a American Treasury or a German Bund?
I think we should look outside the bond market and probably look at gold. Gold has been reacting very strangely the day after of the tariff announcement. I think people were just locking in profit on asset class which have been performing well. But then we have a positive reaction over the last 48 hours. So I think for a safe even asset, we need to look outside the bond market for the time being. But if we need to make a comparison within the bond market, I will tend to see more positive performance coming from the German bond. People think that the debt trajectory is not sustainable, that the deficit will increase. But please keep in mind that what has been announced will bring more growth. More growth will reduce the debt, and the deficit will be just temporary.
Well, speaking of that deficit story, let's put Germany to the side for a moment. Claudia, if we're concerned here about spending, we're concerned here about inflationary costs as a function of the tariffs, and then, of course, the need for public services across Europe to continue to be funded, when do the deficits of France, Spain, Italy become a concern again?
I think we don't have a concern again about the debt level, because for the time being, even if we are trying to increase the 650 billion of funds on the defense spending, has not been decided yet the way to fund it. At the local level, France doesn't have an alternative. We need to reduce the level of debt and reduce the level of deficit. Italy debt level is still very high. Spain is on a better trajectory. But clearly, the fact that the ECB is cutting rates, that probably we will have also a different way to manage the balance sheet, should keep the volatility within the bond market at low level. There are some additional efforts done by France in cutting the level of debt. It will take time. But once again, the cost of refinancing will be lower in a few months with the ECB cutting and then with the slowdown we are expecting.
All right, Claudia Pensari, Chief Investment Officer for France over at UBS Wealth Management. We thank you so much. Guy.
OK, let's talk about where we go next. The market open is 10 minutes away. Let's get you set up for what you need to know here in Europe this morning. Bloomberg Executive Editor for Asia Markets, Paul Dobson, joining us with a perspective from there. Paul, equities are up around the world. Is this anything more than a short covering rally, or has something significant changed here?
A bit of both, isn't it, Guy? I think that what we learned is that Trump is willing to accede to some market pressures and instability, hence the 90-day relaxation of these rules. I think the market takes that as a positive. I think the market is conscious of the fact that deals are possible, and that is also a positive in light of the very extreme tariffs that were announced and implemented. So there are a couple of positives there. There are a lot of clouds still hanging over us, as we were hearing from the previous guest, Claudia, talking about, these are still very intense and large tariffs with a 10% baseline for everyone that the world is going to have to get used to. And the intent from the US government is still the same, to change those supply chains, to change where manufacturing is, and to shake things up. And so from that respect, certainly there's still a lot that's hanging over markets and still needs to be dealt with. So how long the rally can last remains to be seen. And if you miss that bus, it's very difficult to jump on it with such a huge gain in such a short space of time. Futures, I think, were down a little bit for US markets, showing that there is still some anxiety out there, for example. So, a little bit of both. But a short-term win, still a long way to go.
OK, a long way to go, Paul. And what about for the Chinese economy? We understand there's a meeting due to take place today. Yesterday there was a meeting. We got a tariff, and then we got a counter-tariff from the US, and we know the rest. Today looks different, does it? They're going to be talking about ways to stimulate the Chinese economy, perhaps.
So, and we'll have to pay attention to what they say. But I think that what's really fascinating, more than any other market, is what we saw in terms of reaction from China when Trump announced at the same time that higher tariffs on China, and at the same time the relaxation in the more global tariffs. The market rallied. The Chinese traded stocks in the US took off at that moment in time. So the market saw it as a positive. Why would that be? I think two reasons. One, higher tariffs on China directly. At this point, it's going to only cause incremental pain, but may hasten the idea of more support and stimulus from China. We're seeing that already in the weakening yuan. We're seeing that in the Politburo talking as well. Secondly, I think that the market was also more happy about this idea that there is flexibility within the Trump regime and how that could result in some relenting at some point in the future for China than it was worried about these additional tariffs that are coming in right away. So I think that that combination has given Chinese equity traders a little bit more encouragement and hope. Now, as always, the policies seem to have disappointed us, so we'll wait and see what Politburo can say to boost sentiment further from here.
Absolutely. 7.35 on dollar yuan at the moment when you're looking at the offshore currency. Paul Dobson, Bloomberg Executive Editor for Asia Markets, we thank you so much. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Critty. So I've got my eye on airline stocks today after this massive rally in US peers last night. Take a look at Delta, United and American. They were all up around 20%. Take my word for it, they were up around 20%. This is actually the European board, which shows that we have seen a big drop down in these stocks. There we go. I knew I wasn't imagining that. We are seeing American Airlines, United, Delta, all of those up more than 20% at the close on hopes that the delay to tariffs will actually improve the outlook for passenger demand. So keep an eye on the peers in Europe. Then I am also going to take a look at VW, Volkswagen, because a big drop down in profit at the company, warning of potentially some restructuring charges and also emissions impact. But as was noted on the show earlier, the forecast doesn't actually include the impact of tariffs, so a lot of uncertainty still remaining on that. But here's the movement that we can see in the global peers in Asia and in the US. Tesla, Ford, Nissan, all of those gaining by significant amounts. Then keep your eye on Tesco, pretty much confirming what we saw out of Asda a few weeks ago, saying that there is a big drop down in profit in the UK supermarket space, given pricing concerns and also the rise in the national insurance costs. Potentially could be a little bit weaker, although maybe moving in line with broader positivity. Watch Tesco in London today.
Joe, thank you very much. Our equities reporter, Joe Easton. We're waiting for equity markets to open, and they will jump significantly at the start of trade. That'll be a response to yesterday's moves in the US. US futures down 1% on Nasdaq futures.
Absolutely. How far does this go? What was yesterday? Clearly, there was some unwinding of positions. But what does that do in terms of the longer-term picture? We've got a bounce. The bounce is about to arrive. Will it last until lunchtime? The Masters kicks off then, or tees off? We'll find out. This is Bloomberg. Yesterday was a day for shoulder massages and physiotherapy. The whiplash, I suspect that many in the markets are suffering, probably feels like it's probably going to last until today or through today. We're going to watch what happens at the open here in Europe. We're obviously expecting a big bounce. Critty will show you the futures in just a moment. Europe went out here. This is when Donald Trump comes through and delivers the post, which sends markets sharply higher. We rally into the close in the US. Futures have rolled off a little bit since then, so we've got to factor that in. But Critty, it's going to be quite the start.
A historic rally in the States, setting us up for a historic rally on this side of the Atlantic. As you pointed out, Europe wasn't actually trading when we got that news. Today, they're pricing it all in. You can see that, Anna, this morning. Your Stoxx 50 futures higher by a whopping 8%. But what is leading the charge? Ordinarily, we'd look at a move like that and say it's the DAX that may be outperforming. Futures indicate it might be France instead of Germany.
OK, so we'll keep an eye on all of those markets. Yeah, just epic big moves expected, but to a very large degree, this just to catch up on all of the news flow stateside, as you guys have been saying from yesterday. Let's talk about some of the individual companies and the sectors that could be impacted. Aviation very much in focus. We've heard from some of the US airlines. We've heard from Air France. We've got some news flow around Airbus to factor in as well, so we'll watch that sector. Volkswagen in focus. That company's reporting a first quarter profit drop of around 40%. This is a company with quite small, relative to others, exposure to the US. There is a bit of tariff expectation read across, though, into that business. And so that's certainly one we will watch. Tesco is interesting, seeing lower profits as costs and competition hit the UK grocer. So we'll keep that one in mind. Energy could be interesting as well. Energy prices, oil prices jumped yesterday. They're down today. But does Stoxx need time to respond to yesterday's move, Guy?
So here we go. Time for the opening trade this Thursday morning. There is a gap that needs to be filled. We will fill that. Then we'll see where we go from there. We're expecting some big numbers to be posted. How quickly will they be posted? I wonder how long it'll take these markets to get going this morning. Today, at least, it's on the upside. The FTSE 100 up by 0.4% and continuing to climb. As Critty's been saying, we're expecting big moves out of the CAC 40 this morning. Keep an eye on what's happening with the luxury space. Some of the tech stocks that we've also got, names like Schneider, I guess we call that a tech stock now, could be interesting to watch out for there as well. What's happening with pharma? What's happening with the banking sector? There's a number of really interesting spaces that we're going to be watching out for. The IBEX opens. Just take a moment just to watch what is going on the screen in front of you. You're not going to see this very often. Just take a moment. The IBEX just opened up over 8%. You are not going to see many days where you see a European equity market gapping higher by that much. 8% to the upside. These are epic moves. The FTSE 100 is not, at the moment, seeing that kind of action at the moment. And the IBEX is giving back a little bit, but it's still up by 7%. You're not going to see this very often. What's happening below the surface, Chrissy?
Well, below the surface, it feels like the markets are still digesting. They're still processing. And I can see that especially on the FTSE 100, because although the index as a whole is open, there are a lot of stocks here that are unchanged, including the likes of Tesco, for example, which Anna had just mentioned is one of the stocks to watch. But in the Stoxx 600, you mentioned that monster move when it came from Spain. Well, a lot of the biggest index contributors, again, as we're seeing this all shake out, it's Santander, it's BBVA, it's a lot of Spanish stocks at the moment. So something tells me, Anna, we need to wait for this to kind of market to shake out a little bit for us to get a better read.
Yes, and the banking sector is going to be interesting to watch. So some of those names we're seeing in Spain that are open are in the banking sector, and they are, or some of the banks that are open, are in Spain, and we're getting that sense that they could go higher. Some of them are up by more than 10%. I suppose if we're dialing back our expectations of how much the ECB has to cut rates, if we have slightly better expectations for growth as a result of a lower tariff on Europe, at least in the short term, then that helps the banks.
Stoxx 600, 183 stocks are up, 6 are down, 400 are unchanged at the moment.
There you go.
We're struggling to get the bid offer kind of in line this morning. And given the order of magnitude that we're talking to, Santander's up by 14% this morning. It is unsurprising that maybe it is taking a while for these markets to get moving. What is driving it? Obviously, we need to fill the gap from yesterday. I suspect there's quite a lot of short covering out there that needs to be managed as well. Where we go from here, I think, is a much more difficult question to analyse.
There's another element to keep in mind here, especially when it comes to banking stocks, is simply that if the credit crunch or lack thereof is leading the equity market, we should mention that the credit spreads have tightened quite a bit and reversed in the same way that we expected to. So that might also be helping the banking sector as well, because that's where a lot of the pain from the credit story was concentrated in yesterday's trade. We should also mention the bond market as well, because the gilt market has opened as well. Yields surging, falling immediately to 9 basis points, now down to about 7 basis points. The opposite direction of what you're seeing with Germany.
Yes, so it seems that, they're moving in opposite directions, aren't they? And that's interesting because there's that ECB story and taking out the cuts in Europe, which we were talking about with Claudia, that seems to be driving that continual move higher in Eurozone.
Germany's been the safe haven over the last few days.
Yes, so I was referring to France and Italy. No, Italy's different. France and Spain. We're seeing that slight move higher in some of those yields, but not to a huge degree. But the UK is moving in a different direction.
Absolutely. Let's see if that theme of kind of safety in the UK actually holds, because we're talking about 8-10% moves in the Stoxx 600. We weren't seeing that in the futures picture for the UK. Let's see if that holds. Let's bring in John Bilton, Global Multi-Asset Strategy Head over at JP Morgan Asset Management. I don't often kick off a question about the UK, but I'm curious here because all the volatility that we're seeing in every part of the world, the margin of volatility in the UK seems slightly less, volatile, for lack of a better word, less large. Is that a reason? Is that a reason to view the UK as a safe spot in the equity market, in the bond market, arguably in the currency market as well?
Well, I think certainly in the equity market. I mean, we can look at the UK equity beta, and very simply mathematically, the UK has a lower beta to global markets than many of its international cousins. And the reason is the sector mix. You've got a lot of staples, decent chunk of pharma, you've got some energy exposure, and the banks, frankly, are pretty unexciting. They are, they're fairly stable businesses. So the beta of the UK well below 1, so that does make it a safe haven. Also, remember, it's got a whopping great big dividend. And, if you are looking for cash flow, you're looking for safe havens, then that cash return through income is always a good place to start.
We're seeing reports here of trading halts across plenty of individual stocks. The kind of needle in the haystack positivity that we've had in the last five days or 5 sessions has been that the system isn't breaking. It's still liquid enough. We haven't seen signs of stress just yet. What would a sign of stress look like to you? Well,
I challenge that a little bit. Look, markets have been orderly, but they've not been unstressed. I mean, we had, in terms of volume, for instance, in the US Treasury market, it's down to about 20% of what you'd normally expect. So it was skirting around the edge of feeling pretty freaked out at stages in the past few days. But I think what's going on at the moment, I always go back to, let's look at the long-term trends. Think about, Benjamin Graham's quote. It's like, in the short term, the market is a voting machine. In the long term, it's a weighing machine. It's been voting for the past few sessions. There's a lot of noise, not a lot of signal. We're seeing that again. That's why you're getting trading halts. Price discovery takes time. But at the moment, we're responding very quickly to news flow. So oftentimes what we're looking for is where we can get some directionality. And we're starting to see that come through. Credit spreads have been remarkably well behaved, given the spike in the VIX up to 50. That's telling you the economy in the US is still probably a going concern. Considerably slower, perhaps, than what we've seen in terms of things like sovereign spreads. BTPs versus bunds. It's been fairly stable, all things considered, given the risk-off move in equity. That tells you Europe doesn't have a solvency crisis. So what we're starting to home in on is where we think markets are finding pockets of stability and trying to look through some of the noise elsewhere.
So if they're voting at the moment and we look ahead to weighing, I like this phraseology that you bring us this morning. So do we look to earnings season to help us with the weighing, or will that just be a sort of we don't know experience?
I think we're going to see some of that, of course. I mean, but you've seen a couple of sectors starting to come out. You'd flagged airlines this morning. We've seen some of the downgrades coming to numbers, and I think we'll probably see some more of that, some more corporate caution. We're also seeing some of the responses from other sectors to tariffs. Some names suggesting that we don't have the opportunity to pass costs on to customers. So we're beginning to see corporates work through this. That's going to take some time, of course. I think what we'll see broadly is a decent backward-looking picture which underpins the fact that going into this, the economy was actually in reasonable shape, didn't have too many imbalances. But coming through this, there's still a lot of work to be done in terms of understanding the impact. And it's very hard in this period of volatility to see that corporates are going to be bombastic or aggressive in terms of their statements. So I think there'll be an expectation of that happening. If we see tariffs stay where we are, we're probably looking at a year where earnings overall come down close to flat to last year. So ultimately, I think this is just the beginning of seeing that information come through.
Yeah, we were talking with a credit guest earlier on who was talking about dispersion being key on the credit side of things, and specifically talking about the auto sector. I mean, in terms of autos, we're not being very discerning today. All the autos seem to be going higher, but that won't be a surprise to anybody. Up by around 7-8% this morning. Stellantis up by 12%. How picky are we able to be around things like the auto sector or around stocks broadly?
Well, I think we have to be. I mean, certainly, we don't go down to the stocks level, but we certainly go down to the sector level, the regional level, and, parsing through this and understanding, where do we think the negotiations are potentially going to go. We've got new information overnight, which is that there's a pause for most of the world. There's still, going much harder on places like China. I think that's beginning to demonstrate that there is room for negotiation. It's also, clear that there will be feedback loops within the US itself. Corporate leaders will be talking to the administration, explaining why the need is there for carve-outs, how to protect supply chains. Supply chains don't go from horizontally, globally integrated overnight to vertically integrated. And so as a result, there will be parts that we feel will get negotiated through. So we would look at the dispersion that we saw in the equity markets, which was in its lowest decile. Top decile coming into this. We'd expect that to continue for a while. And what we've seen recently has been that jump in correlations, that jump in volatility, which is what's given us this market shock.
If companies withdraw guidance, how does the market react?
Well, I think the market doesn't like withdrawals of guidance. I think they want to see some level of sort of planning for the future. But
how can you plan for the future?
Well, I think what you can effectively say, one of the silver linings that we have at the moment, if you look at things like capex intentions coming into this particular earnings season, they've been right down at pre-COVID levels. There's not an awful way for them to fall from here.
Okay.
So as a result, we think that what you probably see is an extension of we're waiting to see, we've got plans on ice, we talk about the core business, but not get too sort of expansive. I think what the market had been building up ahead of steam for at the beginning of this quarter was the idea we'd see corporate activity, M&A, capex plans, and that's obviously been pulled right back down. And I think corporates will probably lean into that, and I think they'll really go back to their knitting. They'll stick to what's my core business likely to do, what are the risk scenarios, and am I going to demonstrate that I'm a good corporate leader here and keeping it stable through a period of instability.
So Ed Bastian at Delta withdraws guidance yesterday. You don't see more of that. Like he's clearly signalling he doesn't know what the corporate story, what the consumer story, what the corporate story in terms of spending is going to look like. Is there going to be much more of that?
Well, I mean, again, very, very uncertain right now. I think you're going to see some which say, look, we simply can't put a pin in this one. But I think that's going to be a relatively uncommon area because folks will be able to compound up. We know what our supply chain is. We know what the hit to earnings are. Like us, most corporate CFOs will be able to sort of think, OK, I know where I get my costs in. I know where I'm getting hit with tariffs. I know what's certain over the next 90 days. I know what's less certain over the next 90 days. And we'll be able to have some estimates. I think what they'll do is put a reasonably wide range around it. But I think that there will be generally a quite dour, but,
OK, so the centre of that is quite cautious then, I'm assuming, at the middle of that range. Has the market priced in an earnings drop at this point? What does a 5% earnings drop look like? What does a 10% earnings drop look like?
Well, I think we can look at a couple of markets to actually get some information on that. First and foremost, if we take the sort of something of a reduction of tariffs here that seems to be being signalled, we get a effective tariff rate somewhere in the mid-teens.
Yep.
That translates to around about an 8% earnings drop when we look at it bottom up through our estimates of the S&P. What that gives us is low single-digit earnings growth this year, which ultimately, if we put that on a sort of multiple in the low 20s, puts us somewhere in the sort of 53, 5400 kind of range. So the market feels like it's sort of homed in very quickly on what the fair range is. Top side from here, a little bit of Fed help, a little bit more in terms of multiple. You could see 56, 57. Of course, if we go back to getting no tariff reductions, we could be retesting those lows. So it's the market's very volatile at the moment, but it's done a surprisingly efficient job of pricing that out. The other thing to look at, of course, is dividend futures.
Yeah.
If we assume the same payout ratio holds through, what's interesting is the dividend future at the front of the contracts has come right back down to where it was last year. And what that means is it's effectively pricing around about 0% earnings growth, which is in line roughly with where the effective tariff rate is kind of pointing to at the moment. So, low single-digit earnings growth to us would be a good outcome over the course of this year.
Well, John, you went exactly where I wanted to go, which is on this kind of, idea of shareholder returns, because there are two things that have been, I think, driving this market, which is this consumer resilience, the ability to absorb price hikes that have been coming down the pike. I think Apple had like a 43% increase on their iPhone that consumers that hasn't hit the consumers just yet. And the other is the buyback story and the dividend story. But if you see a resistance to absorbing those kind of price hikes from specifically American consumers and a pull down on buybacks, isn't 53, 5400, the range you just talked about, still incredibly optimistic?
It may be if we see the worst of what's being proposed hit. The market was beginning to tell us that there was significant downside. We've seen a top-to-tail reduction so far in the S&P of around about 20%. That's sort of skirting on the edge of a bear market. If you go into a sort of common or garden type of recession, a couple of quarters of negative growth, a bit of an inventory pullback, effectively a buyer's strike, you're probably looking 25 to 30% top-to-tail kind of move. It can get worse than that if things structurally break. Now, where we're optimistic is going into this, the US had a strong degree of resilience. You had a good job market, you had decent balance sheets. Just look at the corporate sector, things like the interest coverage ratio, even across high yield. So actually a decent shape in the economy. And so we don't think that even if we get the worst thrown at this, that we see that kind of really, really deep move. But we've got to be prepared for the fact that we have a volatile path ahead of us, and that's going to dent confidence. And it's not just investors, it's also consumers. If we get that kind of buyer's strike, then the index retesting the lows, certainly not out of the picture. But at this stage, we wouldn't be looking at the sort of wild comparisons to things like the financial crisis, etc. We'd be thinking this is a couple of quarters of technically negative growth, and then maybe a more shallow recovery as the economy resets the changes in the supply chain. In any case, we don't feel sort of 53, 5400 is an unreasonable pricing for the S&P at the moment, particularly ahead of, as Guy mentions, the significant uncertainty that we have ahead in earnings season.
54.72 on the futures, E-mini futures contracts right now, so not too far off from the range that you're potentially talking about. If we're talking about the consumer resilience, the economy being in good shape, we have, however, seen, even pre-tariff announcement, auto delinquencies go up, some layoffs in maybe not the biggest cities of the United States, but kind of the tier 2 cities as well. What is the bigger risk? What will take out more steam from the equity market, the global equity market? Is it the American consumer resilience, or is it the buyback and the liquidity? What's the bigger risk?
Well, I think in the short run, liquidity is a really important point, and it's potentially that brings central banks back to the table, because if the market pricing mechanism breaks, that's where you need an immediate triage from the central banks. As mentioned, in the past few days, we've seen erratic moves, but it's just about being rational in terms of how the market's responded. We haven't seen credit markets break. We haven't seen that kind of washout taking place. Particularly in places like high yield. And that gives us a reason to think that the economy looks OK. When it comes to the consumer, of course, if we start to see significant layoffs, that's where it becomes problematic. The Fed, have a laser focus on the employment numbers. We think if we see 3-4 tenths higher on the U3 unemployment, the Fed will respond. And again, what gives us some level of comfort is that with rates where they are in Fed funds, the Fed have a decent amount of ammunition to be able to throw at the market and can do a lot to improve confidence.
Great to see you, John. Thanks for talking about us. John Bilton, Global Multi-Asset Strategy Head at JP Morgan Asset Management. Let's take a look at the core six, see what's happening. I suspect we're going to see some big numbers on the board. And as you can see, we get those not entirely consistent across that board, but as you can see, from left to right, some very big numbers. Pharma's doing well this morning, luxury's doing well this morning, the chip sector's doing well this morning, the AI trade more broadly into Schneider's doing quite well. Nestle, more of a defensive play, up, but not up by that much. Let's talk about some of the other individual moves. The banking sector's doing well today. We're seeing a big bounce back in other areas as well. Airlines, car makers, the freight sector. Joe's got it all.
So airlines, one sector indeed, Guy, having a very good session. However, bear in mind, we've got this unchanged on the screen for IAG because it's still in a trading halt. Now, I counted around 300 members of the Stoxx 600 were in volatility halts before I stepped away from my desk. I haven't seen anything like that in recent memory in terms of the number of halts. Too much volatility coming into the market, but we can see Air France coming up, Lufthansa as well, having good days. But we'll wait for a price on that one. Then also seeing big moves coming up in the freight stocks, the shipping names, Maersk, Hapag-Lloyd, of course, going to see better trading in terms of the goods being moved by sea. So we're seeing potentially a big jump in Maersk, up around 12% at the moment. Hapag up 10% as well, potentially easing concerns around tariffs and therefore better shipping rates as well. Then the car makers, big gains there. Once again, another sector we could just pick off a low today, but Volkswagen, BMW, Mercedes, Stellantis, all following the global peers higher. We had big moves in the US, Ford, Tesla, all of them were moving higher as well. And then the consumer stocks we picked out because these are the ones with exposure to production over, particularly in Asia. So Adidas, Puma were facing massive tariffs on where they produce their goods, and Pandora as well, Electrolux as well, white goods, washing machines, dishwashers, that kind of thing. Producing goods abroad, shipping into the US, therefore, had faced big drop-offs in those share prices. So we're coming back up on those today. Banking as well, green once again. Barclays up 15%, huge moves, and the investment bank, UBS, getting a decent gain. Santander as well, potentially some relief around Mexico for that one. So all of those big sectors really surging today. Then we'll move over to some negativity because Tesco cannot avoid the drop down in that stock following a warning of weaker profits. Couple of things going on there. Pricing competition from Lidl, Aldi, the German discounters really cutting into their share. And also the jump up in the national insurance costs hitting those companies as well. And then the biggest mover I think we'll find today is over in the chocolate space. Chocolate getting more expensive to eat and more expensive to make, according to Barry Callebaut. Take a look at that one. We're down 17%. It's a big company as well, big chocolatier over in Switzerland, hit hard on a warning around chocolate prices. So not everything rising today. We have been able to find at least one decent move to the downside. Yeah, Barry Callebaut.
Doing well to lose 17% in today's market. Joe, thank you very much. Not all stocks open, but SocGen just opening. IAG is still not open, but most stocks on the Stoxx 600 are now open. Thank you to Joe from our equities team with an update on some of the stocks that are really flying high this morning. We will be back with more on these markets. This is Bloomberg.
Let's talk about the corporates. Let's focus in on what is happening at the single stock level. We bring in Craig Trudell, who leads our automotive coverage, and Charlie Wells joining us for what is happening in the banking sector, what's happening at Amazon and Walmart. Craig, I'm going to start with you and try and figure out exactly what is happening here. We find ourselves in a situation where autos are ripping higher this morning. Tariffs are still being applied. Volkswagen has no idea what is coming.
That's exactly right. I mean, these numbers, pre-announced last night, were on the light side. And I think, it's telling that they had trouble in the first quarter even before these tariffs took effect. One of the sort of wrinkles in this statement last night was a sort of revaluation of some of the vehicles that were on their way to the U.S. And, essentially what they're going to have to do to move those vehicles. The company is trying to kind of hold vehicles off before they get to dealers, kind of wait this out. But while we have a 90-day pause for quote-unquote reciprocal tariffs, auto tariffs remain very much in place.
Yeah. So why are auto stocks going higher? Have we found anybody to answer this question, Craig?
Not yet. It's really difficult to understand, at least from where I sit. Especially since this is not only a matter of big tariffs for vehicles coming from outside of North America, but importantly, still within North America with Canada and Mexico. Yesterday, Canadian retaliatory tariffs took effect. I know Canada's not a huge market, but that is also not going to be helpful. This is still going to be, a significant blow to this industry, and it feels to me like, part of the tariff story where Trump's going to dig in more so than other industries.
It has been a sector he's cared a lot about. I mean, maybe it's all signal, isn't it? And it's someone's reading the signal as this is a president who will change course.
He'll bend even if he said he wouldn't bend.
Yeah, exactly. Maybe there's that.
Well, Charlie, hop on in here. Where else should we be paying attention to? The auto sector has been in focus for weeks now. There's other sectoral tariffs coming down the pike.
There are other sectoral tariffs, and that was something that Trump reiterated yesterday, right? So he talked about how, sure, he's going to be cutting tariffs on a number of countries, but those pharmaceutical tariffs are still coming in place yesterday. He said something to the effect of, we're going to get these pharmaceutical companies to come back to the U.S., and that reflected a fear that a European Pharmaceutical Federation, a warning that they put out earlier this week saying, with tariffs in place, that reduces the incentive to invest in the EU and could send companies to the United States. And that is exactly what Trump was talking about yesterday. So today, I think we should keep an eye on that pharma sector. Of course, at this open, there's so much enthusiasm, but we got to remember the sectoral tariffs.
OK. Critty's obsessed with Walmart and Amazon, so let's talk about that. I feel like this is your question.
Yeah, so, I mean, the superstore, they do so much business with China. And Bloomberg Economics put out this figure this morning saying that, sure, tariffs may be being lowered across the board, but there is still a huge amount on China. And that, overall, we're going to see a reduction in the average U.S. tariff from 27% to 24%, but that's still a historic high. And so companies like Walmart do a lot of business in China. They have been canceling orders, as Critty has said. They have taken price stickers off some of the items that
Christmas ornaments.
Christmas ornaments, that's right, because they're thinking beyond 90 days, right? They're thinking to Christmas. Amazon, we've been told by factories in China, has been abruptly canceling orders. And even the likes of Kohl's, a U.S. Retailer, put in orders recently, one executive told Bloomberg, and then had to cancel the orders. They stopped production.
OK, and we'll see whether some of the things that Amazon has cancelled end up in European markets. Guy, you made the point in the break. They'll have a US plug, so then we'll know, won't we? This will be evidence.
Anna's looking for an air conditioning unit.
Yeah, with a US, I'll find the right plug converter. That's something I can do. That's in my toolkit. Craig Trudell, Charlie Wells, thank you both very much for that. We'll be back with more on the markets shortly. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. Seeing green on the screen. I'm already losing my voice because I've been so excited about seeing this massive margin in the market this morning. Stoxx Europe 600 higher, but just shy of 7%. The outperformer is the DAX and the French index. So a lot of the very heavily beaten stocks are seeing a massive rebound. Does it hold? Does it stay? Given that, of course, we are seeing futures over in the States start to take a little bit of beating. So catch-up trade very much in play in this equity market. I want to take a quick look at the bond market as well, because we are seeing massive moves there as well in some parts of the market. Other parts a little bit more stable. I'm looking at a German 10-year that's higher by about 10 basis points. A massive move in the gilt market as well, except to the opposite direction. UK gilts are bid. France and Germany selling off, Guy.
Chinese Commerce Ministry briefing currently taking place. A few headlines coming out of it. I guess not many of them are surprising. Talking about the fact that you are basically... Oh, it's the Foreign Ministry briefing. We had the Commerce Ministry briefing a little earlier. Both of them coming together to form some headlines that we're getting. China's strongly opposing US bullying. It's reiterating that it will fight to the end. This is the bit that maybe we're not kind of taking on board here. Well, maybe we are. The fact that tariffs remain very, very high, and they remain very high on China. No winner from a trade war, urges mutual respect. What kind of a message would you need to get out of Washington to pull the Chinese into some talks at this point, I think is a really kind of interesting question that we need to ask. We've got, I think, a 30-year auction taking place today. There's action at the back end, once again, of what is happening in the US bond market already this morning. We're watching that quite carefully. Valerie's here to kind of update us on what is going... Yeah, precisely.
On everything.
I keep talking about whiplash today, and it doesn't feel like it's ending in any shape or form, that whiplash. The markets are being pulled from one end to the other, one side of the boat to the other. And today feels like it could be no exception.
Yeah, and I think, I mean, I've got my eye on the long end of the Treasury market. Let's be frank. The 30-year yield is higher on the day. And I want to argue that, yes, Trump has walked back some of these punitive tariffs, but still the loser of this trade war is going to be the Treasury market. If you argue that less global trade is going to mean there's less demand to hold dollars, there's going to be a less demand to hold Treasuries. Combine that with the fact that you are alienating some of the key buyers of Treasuries, that big one being China, you know, second biggest one being Japan. We could just see a long-term, less structural demand for Treasuries going forward. And I think what's laid bare this week is that the Treasury market is trading off of something completely different. It's trading off of deficit concerns. It's trading off the fact that we're heading into some economic slowdown where the deficit is going to balloon. There's going to be extra Treasuries issued into the market, and we're currently alienating those
who's going to own them?
Allies who could be those incremental buyers. And you even see it in the price of gold, Anna. I know you wanted to talk about this. Yesterday saw a massive swing in the price of gold, the biggest jump in 18 months. Maybe a lot of that is just a concern that there is just too much debt out there. You saw the same reaction in the long end of the UK market. Yields were up over 20 basis points in the UK. There is still an underlying concern about debt and about deficits. And I think, you know, tariffs, yes, they might be the main headline, but we really need to pay attention to the fundamentals of what's going on in the bond market.
Guy, your metaphor around whiplash, I was speaking to Robert Dishner yesterday of Neuberger Berman, who gave us another one involving boats. He was saying that when you just rush from one side of the boat to the other, all that happens is you capsize. I'm not sure if we found dry land on that boat just yet.
Depends if the boat's tilted that far that way, going to the other side.
Actual sailor.
I know. Like,
why did I introduce this person to someone who actually knows what they're talking about?
Don't get him started. He'll start talking about the golf.
If you're tacking, then you want to go to the other side of the boat.
Too much detail now on boats. But on that point you're making about deficit concern, Valerie, is that what we're seeing then at the 30-year? That this is still deficit concerns? Because yesterday we were saying, is it that really, or is it just positioning around the basis trade from hedge funds?
Look, there was plenty of deleveraging going on in the Treasury market. Yes, that was one aspect, but deficit concerns is just another aspect that could lead to yields going higher. Balance sheet liquidation only adds to that kind of stress. But I think it just underlines that Treasuries are, you know, since COVID, since this big boom in debt, they are trading off of something different. And you know, Trump needs to realize that. Scott Bessent needs to realize that, because we're playing with fire here if we're alienating the key buyers of Treasuries.
Before this, how close did we get to a real problem?
I mean, it was panic,
Fed intervention
24
was being
hours
discussed,
ago, wasn't it? Fed intervention was being discussed, namely being a backstop to offer liquidity to those banks who didn't have
market
balance
participants,
sheets.
I mean, when I say discussed.
And maybe that's another reason why we saw gold rising, because at the end of the day, the market is somehow assuming that QE is the only way out of this debt cycle. And you know, the price of gold is telling you the same message.
Valerie, thank you very much. Bloomberg's Valerie Teitel. Let's pivot to an equity conversation with Marina Zavalok, Chief European Equity Strategist at Morgan Stanley, with us on set this morning. It's a noisy set, Marina, but I sort of apologise, but also it's the energy of the market, I suppose, that's coming through day after day. Where are we now, then, in your thinking? Because on the one hand, it's easy to look at what we see on our screens here in Europe and say crisis averted, but on the other, relative to history, the tariff level in the United States is still high. So where does that leave us?
I mean, also, corporate uncertainty is very high. So you have a 90-day pause, but how do you make investment decisions as an investor, but also as a corporate even more? I think it's difficult. I mean, we've been saying into the sell-off that the risk-reward for European equities became very negative. I would say it's still pretty negative. So if we kind of return to where we were, which I think will be difficult given the level of U-turns and uncertainty here, maybe 7% upside from here to the index. But then we have kind of a moderate bear case scenario, which still has 10% downside. And then if we go into a global recession on the back of this uncertainty, and if tariffs, you know, even just stay in place, that it's not our Morgan Stanley base case, but it's possible, that would be 25% downside.
Right. So in terms of the upside scenario there, how much is baked, or what is baked into that? What assumptions do you make to turn out to get something really positive?
We in our base case, which we had into this year, so at the end of last year, we assumed 10% tariffs, but with exemptions, with meaningful exemptions. We assumed no rebound in European stocks with high China exposure. We assumed some tax incentives in the U.S. for local manufacturing production to incentivize that. So it's plausible that we go back there. But
that's interesting. That is still some
we did not
widespread
assume
tariffs.
The one thing we did not assume is a meaningful U.S. growth slowdown.
How much of that can, excuse me again, how much of that can European equities absorb, though, given that so much of the exposure in, say, the FTSE 100, but also the Stoxx 100 is exposed to the U.S. consumer?
Yeah.
Is there a way to gain market share in other parts of the world if there is this slowdown in the works?
Yeah, so one thing, so there's been this debate about Europe being maybe a safe haven and, investors moving money out of the U.S. into Europe. And I've been really firmly advocating that Europe is not really a safe haven. We are a very cyclical index. 2/3 of our index is goods. You have the opposite kind of dynamic in the U.S.
Yeah.
About 25% of our exposure is to the U.S. You have some of that is goods export, some of that is local to local, but it is exposed to a growth slowdown in the U.S. And then on the prospect of finding that growth elsewhere in the world, you have to compete with China for that growth elsewhere in the world, and that competition just went up. So I think the environment for European companies is difficult.
Well, so many European companies have also been rallying on simply buybacks and shareholder returns and taking a page out of the U.S. playbook, frankly.
Yeah.
Is that where some of the steam gets taken out of the rally we are seeing in this kind of safe haven umbrella in terms of getting caught between the U.S. and China? Is that the first kind of signal of caution when a lot of these European companies start pulling back on their buybacks?
I mean, that would be a big signal if we start to see that. We've already seen a slowdown in M&A. So I think we're hearing about corporates just pausing even investment decisions relating to CapEx. We're hearing corporates pausing M&A decisions. We're seeing that in the data. I think if we start to see a pause in buybacks or dividends, which we haven't really seen so far, that would be an incrementally negative sign.
If the ECB cuts hard, would that help?
It would help. I think our view is the ECB has more room to cut than the Fed.
Yep.
It would be helpful, but if you have growth really slowing down at the same time and corporates profit warning, then you're still in a net negative situation.
German fiscal, if you plug in more fiscal spending?
Yeah, so we've done a lot of work on German fiscal. We've compared especially the infrastructure fund to the Infrastructure Investment and Jobs Act in the U.S.
Yep.
And our call basically was we're going to get to travel and arrive at the time of this infrastructure spend passing, which is exactly what's happened. So we got to travel and arrive event. We started to see a pullback in the stocks exposed to that. The problem you have is that a lot of the spending is very long dated. We've had companies tell us that once projects, big ticket items start being announced, it will be 3 years from the time that project is allocated to the time the shovel hits the ground. So it's not going to save you this earnings season.
Yeah.
And then on top of that, your major companies that have exposure to that infrastructure spending, they have more exposure to the U.S. And up until recently, they were trading like they have no U.S. exposure, and it was all about Germany. So that's the problem here. On defense, it's a completely different story. We're very bullish on defense. We basically think it's still under-owned, especially by long-only funds.
You buy any dip? There's been some big dips recently. You buy those?
Yes. Yeah.
Okay.
I mean, if you look at the weight of defense in the European index, it's roughly 1.5%. And so many companies in Europe are massively raising defense spending.
Yep.
The German unlimited defense spending adds up to 700 billion to 1 trillion, depending over time what time horizon it is. So just the level of investment going into defense relative to the size, the weight in the index, it doesn't add up.
And we'll see where that money gets spent and whether that gets caught up in those trade conversations that are then going to be coming quick and fast. What about the banking sector then, Marina? Because we've got that's the best performing sector today. Maybe just a response to rethinking ECB rate cut expectations, European growth threats. How sustained should outperformance in banks be, do you think?
Yeah, so our concern with the bank sector recently has been that amid the optimism around, the prospect of a Russia-Ukraine peace deal, cost of equity compression on the back of that, this kind of reallocation of flows, banks were trading for some time like a one-way train. And not pricing much at all for recession risks. At this point in the cycle, where we have much more kind of late cycle dynamics, we think banks trade a lot more like cyclicals. And we've been recommending a rotation into defensives out of cyclicals. We think this bounce today is a good opportunity to keep reallocating. And then so far, you see bond yields in Europe and the UK kind of following the trend of the US broadly. But at some point, that's likely to diverge because you have an ECB that's more likely to cut than the Fed has room to do.
I'm going to leave it there. That was really interesting. Thanks
you.
very much indeed for stopping by to see us. Marina Zavalok, Chief European Equity Strategist, joining us from Morgan Stanley. US futures have just started rolling over quite hard. And you are seeing some much more bigger downside numbers on the screen at the moment. It's happened in the last kind of 10, 15 minutes. Even the futures are down by 1.5 right now. So it's going to be interesting to see how that ultimately folds into the session that is approaching in the United States. At the moment, looks like we're going to unwind some of the gains that we saw coming through yesterday post-Trump's reversal. What are we going to talk about next? More market volatility, tariff uncertainty. What does it mean for capital raises? What does it mean for capital markets? What does it mean for IPOs? Silvia Vivano, UniCredit's head of equity capital markets, joining us next. This is Bloomberg.
Welcome back to the opening trade. We are 46 minutes into a very eventful session. We're up by 5.8% on the Stoxx 600. So certainly seeing that rebound in global risk sentiment that we saw in the US into Asia, coming through into Europe, as you would expect. But US futures do point downwards, down 1.5% on E-minis, as Guy was just saying before the break. So we'll watch to see how long this bounce lasts. Banks in particular strong this morning. Chrissy, let us find, with that in mind, what has caught your eye?
Well, we are seeing this rebound in the equity market, maybe a little bit of compression in that spread widening as well. Here's where it's not showing up with as much enthusiasm. It's in the financial conditions index. And this, I think, is really important because we've seen this kind of comparison in the last couple of days to 2022, 08, even the 2020 COVID crisis. And let me put this in some perspective here. This is an index that takes into account not only the equity sell-off, but, of course, the widening of credit spreads and dollar weakness as well. And you can see where we are in comparison to these historic levels. So we are certainly in more financial stress, more financial tightening, I should say, relative to the 2022 sell-off that we had, where the Federal Reserve was going on kind of a very quick and very aggressive hiking regime. But we're not quite at those stress levels of 2020. We're not even close to that of what we saw over in 08 and 09. We're getting a little bit close, though, however, to that European sovereign debt crisis. And perhaps that's where you start to see these comparisons really worry a lot of these investors, because even with the rebound that we have seen today, and it has been, Guy, a monumental rebound, at least in the early starts of this trade, it's only a tick higher on this index. We still have some ways to go.
It's easy to lose some of these moves in the longer-term charts, certainly, Chrissy. And the volatility that we're seeing, certainly very relevant to the conversation that we are going to be seeing next. Market turmoil disrupting IPO plans, companies such as Klarna and StubHub postponing their listings. Joining us now to discuss the latest, Silvia Vivano, head of equity capital markets at UniCredit. Silvia, thank you very much indeed for joining us on the show. Just walk me through what is happening right now. We've got extreme volatility, massive swings. What does that mean for those that are looking to raise money or come to markets?
Hi, Guy, and thank you for having me. That's actually the question that everyone is asking himself right now, right? From an equity capital markets perspective, volatility, especially for IPO transaction, is not what you need. To summarize, I think what we are seeing right now and the discussion we are having with our client is, let's see, this is a pause moment. We need to evaluate and consider a bit more what's happening in the markets, and then take action once a bit more of clarity will be available, right? Klarna and StubHub were the first one to actually pause the IPOs. Many more announcements will come, or we will not see so many launches or opening of the books as we were hoping and expecting just a few weeks back.
So, has something structural changed here as well? Is this a more permanent feature of the landscape that we are going to be seeing the kind of volatility we've seen over the last few days? The danger is it could erupt at any point. And therefore, if you're planning an IPO, if you're planning a capital raise, you just don't know the kind of market you're stepping into. Is that a permanent feature? Has the landscape changed significantly and permanently as a result of what Trump is doing?
I think there has been, for sure, a damage has been done to the economy and also to the sentiment within the equity capital markets. The uncertainty is never something good for an ECM perspective. And again, from an IPO standpoint, I'm not expecting companies to actually get listed before summer this year. There is, as you mentioned, Guy, volatility is too high. It's really, really difficult to actually get exposed for over, let's say, 10 days during the book building period to what's happening to the market. And so I'm not expecting IPOs for the first part of the year to arrive. From a capital increase perspective and more accelerating transaction, intraday volatility or very brief bounces in the market actually could play a positive role. We should assume, and I think Q1 results, publication of results will be quite important because I think companies will need to reassess and give a bit of a hint of what they're expecting in terms of, forecasts and potentially rebudgeting for a year to come. And then I think on the back of that, I think we will understand whether companies will be able to take advantage of some positive trends in the market and raise capital quickly overnight, or whether they will also need to wait for the second part of the year. Is it a structural change? For sure, currently and for the next few months, yes. Hopefully, some stability will come back at the end of the 9 months, of the 3 months, and then we will have better visibility on what can be done.
Yeah, Sylvia, so to follow on from Guy's question, if you say that IPOs are not going to happen in the short term because of this expectation of heightened volatility, then that does suggest that people are waiting for something calmer on the other side of these 90 days. In equity capital markets, is that a safe assumption, do you think, given what we've seen from this presidency up to now?
No, the reality is I completely agree with you. And from an equity capital markets perspective, it's difficult right now to forecast or to make proper assumption of what's going to happen at the end of the 90 days holding period. The best thing we can do, and the discussion we're having with our clients across Europe, is keep on working in the preparation. There were many companies that were actually working and getting ready to get listed. So the suggestion is you now have the time to get ready and in full shape from a corporate perspective. Get your numbers in the row. Make sure that your forecast and from a business plan perspective, everything is secure, if possible, because clearly tariffs will play a role. But then to be ready to hit the market and take advantage of potentially more stability after summer. Is it something we can guarantee to our clients? Absolutely no. What's going to happen at the end of the 90 days is something that we can't predict yet. But the best we can assume and the best we can offer to our clients is to keep on working and be ready in order to tackle the first market window as soon as available.
Sylvia, do you perhaps anticipate any change in appetite when it comes to fundraising to, instead of accessing the equity capital markets, to do it in the debt capital markets instead? Is that a trade-off that could come from not just American issuers, but European ones?
I think it's something that we need to evaluate in the next weeks, right? I think what's quite interesting was what we saw last night in terms of the divergence between equity capital markets and credit markets. If the credit market is tightening and they're going to be companies are going to struggle to raise a capital in the debt market, I think equity raise will become more relevant. And then I think companies will need, in any event, to take advantage of the volatility, doing, as I said, accelerated trades overnight in order to raise equity to sustain their business. So I think we are not ready to make this assessment, but for sure what we are seeing in terms of divergence between equity and debt, which has not been aligned to the past, is quite interesting.
Yeah. Sylvia, what about kind of the accessibility of the U.S. markets right now? I ask this in the context of the fact that with this volatility, we're seeing a hesitation from international investors in some ways to not necessarily dive into the dollar, to not necessarily dive into the Treasury market to the same extent they have in previous crises. Does that kind of almost hesitation around the United States right now, given that that's where the epicenter of the shock is coming from, translate to the IPO market? In other words, could international investors looking to IPO in New York suddenly look at London, Paris, Milan as a more viable alternative?
I think it's a very fair point and it's a very fair statement. From a European perspective, I think what's happening to the US, it's a positive. If you look in-house and if you look at Europe, the fact that everyone is actually coordinating and aligned in order to take action and become more independent from the US is giving a bit of stability and solidity to the European market that is going to eventually bring more positive results to the European companies, the European investors. We have already been seeing quite a very interesting inflows of money from international investors into Europe. So net-net, I do believe if there is a concerted efforts across all the stakeholders in order to sustain and push a bit the European capital markets, that this move against the US and the US dollars could actually prove to be a positive sign for European companies and investors.
Sylvia, thank you very much. Sylvia Viviano, Head of Equity Capital Markets at UniCredit, putting the IPO story and other capital markets activity in today's context. Thank you very much for that. We're going to be speaking to Jean-Claude Trichet, or Bloomberg TV. We'll be speaking to the former ECB President, Jean-Claude Trichet. So all matters European economy. Interesting to hear about from him, of course, where the latest moves leave him. It was interesting in that conversation with Sylvia, you were referencing the dollar and the fact we haven't... I mean, it's almost like, when you look at dollar charts, it's almost like yesterday didn't happen. The reversal in policy or the wind back in policy from the United States didn't really happen. And to Val's point, we're still seeing some signs of stress at the long end of the US Treasury curve.
I mean, if you're European right now, your purchasing power has increased significantly. Your dollar's at 110, given the fact that you're still talking about structurally weak economies. You're talking about some profit margins that are already looking to drop. Just take a look at the Volkswagen numbers as well. And yet, things are looking pretty good. The sentiment is pretty bullish.
I will I'll just talk a little bit about what US futures are doing right now. They're rolling over fairly sharply at the moment, which is going to set up an interesting session ahead. Obviously, a massive rally yesterday. How does that unfold for the rest of the day? We'll wait and watch. I think the Masters kicks off at around 12:30. That's the afternoon. The morning's going to be interesting. The afternoon will be relaxing. This is Bloomberg.